You know what I mean? And like, if you need to be liquid, I would argue you probably shouldn't have it in crypto. You know, like if you need that money to like live on and be liquid, but a lot of people did that. A lot of people speculated and went and put 100 grand or whatever into crypto. I would argue like, if I was going to put money into crypto, I'd rather take a loan against my policy, put it into crypto, because if that underlying asset that I invested in crashes, I have the ability to like not just have lost that money, I can systematically rebuild inside of the whole life policy by managing that loan and recapitalizing the policy while never have interrupted that growth, right? And my human life value is insured the whole time, right? Like, which we cannot, like, I feel like a lot of people that focus on the cash value element, the banking side of policies, they really downplay or even completely negate. And they say, I don't even care about the life insurance. Like when to me, that human life value part of it is huge, right? Like the fact that we have I love investing for cash flow, right? So the fact that we have the ability to basically buy our net worth. A lot of people, and let me start this. A lot of people will say, oh, whole life is great if you're already wealthy, right? It's a wealthy person's product, right? Like I would argue it's like it works for them, and the wealthy people understand the values of it, and they understand it because they're more sophisticated. So that's why they do it. But I would argue for middle class, it's even more important because as a middle class person, chances are you don't have your whole human life value worth of money stuck in an account. So if something happened to you tomorrow, your family would be screwed, right? Like, or not be able to live the life you wanted to live. So you can buy your net worth and then focus on investing for cash flow as to actualize it over a period of time. There's no other asset in the world that can do that for you. And that's why I love it.
Right. Yeah. So yes, I like that. And I'm endorsing too what you said a minute ago. So I'm okay. So folks, we'll try to link to this. So again, this is InFi episode 3. If you want to look this up, we'll put it in the show notes. But yeah, I recently did a thing, Chris, on the uninterrupted compounding. And there I was just making the point. I said, I'm okay with, some person A's got 100,000 in cash surrender value in a whole life policy, and person B just has it like in a savings account, and they got to make a $20,000 purchase, and just look at the pros and cons. And so, yeah, I think it is significant to say person A, when they take out a $20,000 policy loan, every year they can look at their statement, and that loan is just looking at them and saying, this is the consequences of your previous, if you could just pay me down, then you'd have, you know what I mean? So I think the psychological element there makes the person more frugal probably, whereas person B, who just took it out of the savings account, that money's gone. They don't see the shadow of that, the ram of, they're just, but even there though, but just to be clear, like it's a psychological thing. It's not, if the cash flows were the same, in other words, nothing stopping person B from putting in the same amount that person A does. It's just probably, when you see the loan sitting there, it's more of a target, and it might make you, more likely to be frugal to knock that thing out. So I definitely agree. For human beings in the real world, this strategy is well designed to really encourage frugality, and why you probably end up with a higher net worth down the road. But the reason is for this kind of stuff you and I are saying, not because it makes sense to lend at 4 and borrow right back at 6 from somebody. Like, no, that per se doesn't make sense.
Well, and so let's talk about that for a second of why that happened though. Because if you think about it, one of the reasons that I think this has happened is because the idea of positive arbitrage, and this is something I'm really passionate about. Like the idea of positive arbitrage in a whole life policy with a non-direct recognition company is absolutely possible, right? Like it's not, I'm not sitting here saying, and I want to make this really clear, that I'm not sitting here talking to you saying it's not possible, because it is. It's just not the principle in why you're doing this, right? Like, and that is an extremely important part. And I think what's happened is maybe some people aren't as nerdy as you and I are about like really dissecting this stuff. And, they haven't been doing this long enough, because I know a lot of these influencers are online talking about this, and they're going and they're only like, hey, I've been doing this for 6 years, someone would say, and this is what I know. This is what I've seen. But the bottom line is we've been living in this decreasing interest rate environment. And if you understand rates and dividends and all these things, like I know you do, and you're working with a non-direct recognition company, as dividends or as interest rates are going down, dividends chase rates down. As interest rates start going up, dividends chase rates up. There's always a lag, right? And so we're now in this point where we hit a crossover where interest rates are going up and dividend rates are now lower with these non-direct recognition companies than the cost of borrowing. A lot of these people that have been in the industry for less than a decade, and they've never seen that. I mean, from 1980 to today, rates have been doing nothing but going down or being flat. And it's been kind of like a beautiful scenario. But even then, even in that environment where positive arbitrage in the environment made possible, the principle of it is you still have to capitalize the policy. And I'd love to hear your take actually on that, because that is a big thing. The idea of positive arbitrage. Yes, I love it. You can do it. But there is that capitalization phase that has to happen in the policy before it becomes efficient enough to actually achieve that internal rate of return on an annual basis high enough to achieve that positive arbitrage, right?
Right. So yeah, I think if I'm tracking what you're saying, that there's policies and ones that I've recently looked at the illustrations for that, if it's a healthy person or whatever, the internal rate of return, including, premium payments and dividend rollovers and things on the non-guaranteed side, it can, it breaks 4%. And when you can take into account tax considerations, that's nothing to sneeze at, especially given how safe it is that once it achieves a floor, it can't go down and you have access to it, via policy loans and such. That's a great type of asset to hold. But even there, like you're saying, you got to have the thing, those only are hitting 9-10 years into the policy at the earliest.
Right.
And so it's not that you can just set that thing up and then, if you needed to you're financing some purchases for your business, you couldn't just start this thing on a dime and then be having it not only finance the purchases, but you're gaining every year a little few basis points and making money on the side. That's not going to happen right away.
And I do that a lot for real estate, right? So we get a lot of people that do big front loads in and then annual premiums. And the goal is to try to pull as much possible out for real estate transactions as quickly as possible, right? As much as they can, as quickly as they can. Let's say 45 days later, they want to buy a real estate property, with it. The trick there is you got to get that real estate investor to see all right, this is a long-term strategy. There is going to be a capital crunch at the beginning. If you put in $500,000 and 400 of that is upfront, single PUA rider, and then the rest is 100,000, say 50-50 blend or something like that. You're looking at 450 is going in PUAs and 50,000 base. Now we're talking out of that, you're going to have a net cash value of maybe 440, 450. And then out of that, you're going to have liquidity of 90%. So you're talking 400,000. So you're going to lose 20% liquidity out of the gate. I would argue it's worth it. When you look from a long-term perspective, when you work on it all and it's part of your system moving forward. But if you were to just take that one transaction in isolation, we could have a conversation as whether the capital crunch is worth it or not,
Yeah, it's funny you're just saying, because this is literally the stuff 2 weeks ago we were doing with a business owner, and it was exactly that. I mean, the numbers were different, but same principle.
Yeah.
And that's exactly what we did. And to be fair, so what we're showing is you're going to have to kick in more out of pocket in year one because of the fact that, it's not fully available to borrow. And so to do the apples to apples, we were saying, contrast it with what you're doing now, using Ford financing, for these vehicles, and just showing you putting in that cash, that out of pocket, into some other vehicle earning 3% after tax or something, just to, and it was in early years, the net worth was higher in the conventional approach, but then I think it was year 9 in this particular example, it crossed over where counting everything, you still had more cash. And then like you say, but the trump card was all along, the person had $2.5 million of extra death benefit. And then that just kept growing. And so to say, that's not negligible. Again, you're not going to probably die next Thursday, but over the next 20 years, you could die. And in which case, this strategy gives you an extra at least $2.5 million that grows over time, that passes income tax free to your named beneficiaries. So that's a great little perk to have here, and we shouldn't neglect that.
We shouldn't. I mean, as much as I like to rail on IUL, and I sold a lot of IUL my first 4 years, but talking right now about the human life value element of it in the life insurance side. That's the one thing IUL and whole life has in common. Out of all the policies I sold for IUL the first 4 years in the business, one of them is still on the books. I transitioned all of them except for by the time I went and I realized what I realized, I went to transition one of them and the guy had gotten cancer. And it was a monster policy. Like for me back then, it was actually my largest policy at the time that I had ever sold. And because of the fact that he got cancer, he was no longer insurable, I promise you, he didn't care as much about the human life, like about the cash value. He cared more about his human life value at that point in time. And the fact that this thing had a $9 million death benefit with it is what he cared a lot more about than having the liquidity and access to the cash and doing all this stuff. And so we just kept that in place. And, he ended up passing on a couple of years after, but his family got the $9 million, So like, that's the one thing I'd say, like IUL whole life. And like, it's the human life value is not something to, because our health is not guaranteed. Tomorrow's not guaranteed. Like I call this a self-completing plan. It makes sure what you want to happen will happen when you want it to happen, whether you're here to see it or not, period. Like no other asset in the world to do it for you. Only whole life insurance.
Hey everybody, this is Bob Murphy. Thanks for listening to this clip from the Infi podcast. If you like what you heard and want to hear more, please consider subscribing and share this video with others. We've got new episodes dropping every Friday with more insightful discussions. Stay tuned.